Welcome back to the deep dive. Grab your helmet because today we are taking an immediate and, well, pretty aggressive ride into TVS Motor Company's latest numbers. We're looking at the unaudited financial results for the quarter and the half year that ended September 30, 2025. So Q2 FY26. Our mission, as always, isn't just reading you the data. We want to give you the shortcut to actually understanding it. So we'll quickly pull out the big achievements, unpack which vehicles are really driving this momentum, and importantly, dig into some of the strategic notes, maybe even potential risks hidden in the fine print.
Absolutely. And look, if you just need the headline right now, pin this. This wasn't just a good quarter. It's the story of record-breaking growth, really comprehensive. They posted their highest ever operating revenue, highest ever EBITDA, PBT, and total sales units for the quarter. I mean, every single dial seems cranked up to 11. It's genuinely impressive stuff.
Okay, record-breaking. Let's unpack that financial success then, starting with Q2 FY26, and we'll compare it back to Q2 FY25. Operating revenue first, it absolutely soared, hitting 11,905 crores. For context, 1 crore is 10 million rupees. So that revenue figure is a massive 29% jump over the 9,228 crores last year. That's just phenomenal growth at the top line.
It really is. And, the profitability story, I'd argue it's even more impressive because it seems driven by some serious margin improvement. Operating EBITDA hit 1,509 crores. That's a stunning 40% increase. 40%.
Wow, okay, 40%.
Yeah. And when your profitability grows faster than your revenue, that shows real operational leverage kicking in.
So operational leverage, what does that actually look like? How does that translate?
Well, it basically means they're squeezing more profit out of every new sale they make. You see it quantified in the margin improvement. The operating EBITDA margin went up by a full 100 basis points, so it climbed to 12.7% from 11.7% the year before.
The full percentage point?
Exactly. It suggests their fixed costs are covered, right? And each additional sale is dropping a bigger chunk of profit down to the bottom line. They're not just selling more, they're selling smarter, more efficiently.
Growing smarter. That seems to be the key takeaway there.
Okay.
Now let's talk profit before tax, PBT. That also grew very aggressively, up 37%. It reached 1,226 crores compared to 897 crores in Q2 last year.
Right, but this PBT number, it holds a really key detail. It shows why just looking at the percentage growth can sometimes be a little misleading. See, the Q2 FY26 PBT figure actually includes a fair valuation loss on some investments the company holds. That loss was about 31 crores.
A loss, okay.
Yeah, and that's a sharp contrast to Q2 of the previous year, where they reported a 23 crore gain from the same kind of investment valuation.
I see. So that's a swing of, what, 54 crores between the two periods just on paper valuation?
Exactly, a 54 crore swing. And it matters because it kind of de-risks the underlying business story. This valuation volatility, it shows the core operating growth. The actual selling of two-wheelers and three-wheelers is performing even better than that 37% PBT number might suggest at first glance.
Interesting. So if you strip out that investment noise, the operational growth is even stronger.
Probably yes. It demonstrates resilience in the core business, even when financial markets are, a bit bumpy.
Understood. Okay, so we've seen the impressive cash flow, the efficiency gains. Now, what fueled it? I mean, that money has to come from selling actual vehicles. Let's shift to unit sales.
Precisely. The volume story is the engine here, no question. Overall, total two-wheeler and three-wheeler sales, and this includes their international business, hit a record 15.07 lakh units.
15.07 lakh? That's just over 1.5 million vehicles.
Yeah, right, in a single quarter.
Right.
That represents really strong 23% growth year over year. Huge volume. And if we break down the segments for Q2, the growth is pretty broad-based. It seems like strong market acceptance across the board. Motorcycles grew by a solid 20%, hitting 6.73 lakh units.
Okay, 20% for motorcycles.
But scooters showed an even higher growth rate, up 30%. They reached 6.39 lakh units.
30% for scooters? That's quite a jump. Reflects maybe urbanization trends, personal mobility shifts?
Could be. It definitely points to strong demand in that category.
And then there's the commercial side. The three-wheeler segment saw the highest percentage growth, right? Up 41% to 0.53 lakh units.
Yeah, 41%. A huge spike.
Is that TVS just grabbing market share, do you think? Or is that whole commercial transport segment just exploding right now?
Probably a bit of both, but I suspect mostly the latter. That 41% jump suggests massive underlying demand. Think last-mile connectivity, utility vehicles. Commercial transport has really accelerated, especially in developing markets, and TVS seems perfectly positioned to capture that demand for affordable, practical vehicles.
Makes sense. And this demand isn't just domestic, is it? Their global reach seems to be expanding significantly too. International business sales, that's both two and three-wheelers, grew by 31%. They sold 3.63 lakh units outside India in Q2.
Absolutely key. That diversification is crucial. When your international growth outpaces your overall unit growth, you're actively de-risking your reliance on any single market. Selling over 3.6 lakh units internationally, yeah, that makes their whole growth story feel much more sustainable.
Okay, now let's zoom in on a segment that's absolutely vital for the company's future narrative, and probably its valuation, electric vehicles. You said this volume is nested within the scooter numbers.
That's right. So we saw that explosive 30% growth in the overall scooter category. But EV sales specifically, well, they did achieve a quarterly high of 0.80 lakh units, so 80,000 vehicles. But the growth rate over Q2 last year was much more modest, only 7%.
Only 7%. That immediately raises a question, doesn't it? Why the slower acceleration in EVs compared to the overall scooter segment?
It does. And this is where the financial filings give us a really critical, very specific piece of insight. The company explicitly noted, and I'm quoting here, magnet availability continues to pose challenges in the short to medium term.
Magnet availability. Okay,
Ah,
that's a very pointed constraint to mention.
it's a huge flag. This suggests it isn't a demand problem for their EVs. It sounds like a supply chain bottleneck. And it's rooted in a specific component, these rare earth magnets, which are essential for efficient EV motors.
Right, high-tech component.
Exactly. So the company is essentially signaling that their EV production capacity is being held back, not by engineering, not by sales, but by commodity supply issues.
Short to medium term, they said.
Yes, which implies if they can solve that magnet supply issue, that 7% EV growth rate could potentially shoot up quite dramatically.
Interesting. So even while fighting that supply pressure, they're still pushing ahead aggressively with new products. They launched 4 significant new vehicles in just the last 3 months. That shows confidence.
It really does. They're clearly planting seeds for future growth across key segments. In EVs, like you mentioned, there's the TVS Orbiter. Looks like a smart, stylish EV targeting urban commuters.
Yeah.
And crucially, they also launched the TVS King Cargo HD EV. That one's aimed squarely at urban logistics strength, space, sustainability, tackling that growing commercial EV sector.
But they didn't ignore the traditional engine market either. They pushed into premium ICE segments too. There's the TVS NTR RQ 150.
Yeah, they're calling it India's quickest and positioning it as a hypersport scooter, aiming for that young, performance-oriented demographic.
And then there's the super premium move with the TVS Apache RTX, a new adventure rally tour.
Right. That's a real signal of intent. It shows they're willing to compete head-on with established high-end brands in the adventure touring market. It's about brand building, chasing higher margins in niche segments.
Okay, let's zoom out again. Look at the bigger picture over the first half of the financial year H1, so April to September 2025. See if the momentum holds up. Total revenue for the half year grew 25%. Hit Rs, 21,986 crores. PBT grew even faster, remember that trend, up 36% for the half year to Rs, 2,279 crores.
Consistent growth.
Yeah, and total units sold over the 6 months, 27.84 lakh units. That's a 20% increase. So the half-year results really just reinforce that Q2 wasn't a fluke. It's sustained momentum.
And if we connect this back to financial stability, growth is fantastic, but you need a solid foundation. On a standalone basis, TVS Motor looks like it has a fortress balance sheet. Their net debt-to-equity ratio, it remains extremely low, just 0.25 times for both the quarter and the half year. That indicates a very manageable debt level relative to their equity.
So they aren't funding this expansion just by loading up on debt.
Doesn't look like it. And check out the interest service coverage ratio, the ISCR. It tells you how easily they can cover their interest payments. It's exceptionally strong. Stood at 32.01 times for Q2. Basically, they could cover their interest costs 32 times over with their earnings. Zero trouble servicing their debt.
32 times. That's comfortable.
Very comfortable. And we also see they're actively putting capital to work for the future. The report mentions a substantial investment during the quarter, 552.17 crores invested in subsidiaries.
Okay, over $500 million rupees.
Yeah, strategic capital deployment. It's likely going towards bolstering their financial services arm, maybe expanding global manufacturing or other future growth avenues. They're funding the pipeline.
That investment definitely confirms they're building out the ecosystem around the core vehicle business. And looking at the consolidated H1 results, you see the segments clearly. The two big pillars are automotive vehicles and parts that brought in roughly 22,810 crores and financial services, which is quite substantial at nearly 3,500 crores.
Right. That diversification into financial services, which supports their vehicle sales, seems to be paying off nicely. Adds stability. Oh, and there's another interesting corporate development noted in the filings. Reflects that premium strategy we talked about. They reported the incorporation of Norton Motorcycle Private Limited in India. It officially became a subsidiary of the UK Norton Company effective August 19th, 2025.
Norton, right? That's the classic super premium British brand they acquired a while back. So incorporating it in India, does that mean they plan to actually build or assemble Norton bikes locally? Or is it more about managing the brand?
It strongly suggests the move towards localization. Could be supply chain, could be assembly, maybe even setting up a distinct retail presence for Norton in India. Either way, it positions them to really leverage the prestige of that Norton name within India's booming premium motorcycle market. Get more value out of that acquisition.
Makes sense. Okay, finally, let's pivot quickly to regulatory risk, because that can often shape future costs and profitability. The documents mention the Environment Protection End-of-Life Vehicles Rules, 2025, the ELV rules. They came into effect April 1st, 2025. And these rules put extended producer responsibility EPR onto manufacturers like TVS, basically making them responsible for dealing with vehicles at the end of their life cycle.
This is a pretty major regulatory shift, and it raises an important but currently unquantifiable risk. The company specifically states that while these obligations now exist, they can't reliably estimate the cost of meeting them just yet.
Why not?
Because the government infrastructure needed the centralized portal, the frameworks for managing EPR certificates, they're apparently not yet operational.
So the regulator has handed them a future bill, potentially a large one, but the actual amount is TBD, to be determined.
Precisely. It's an unavoidable future cost, could be significant, hanging over their balance sheet. And until the government fully rolls out the mechanics for tracking and trading these EPR certificates, TVS and frankly all vehicle manufacturers are left guessing about the true long-term financial hit.
Definitely a watch point for future reports then.
Absolutely.
So, okay, let's wrap this up. What's the essential story here for you, the listener? It really seems to be one of massive, efficient expansion for TVS Motor. They're riding strong demand both at home and internationally, pushing key metrics to record highs and making strategic bets in premium, logistics, and electric segments to secure future revenue.
Yeah, it's an incredibly strong performance overall. And it's backed by that really solid balance sheet, great debt coverage. They seem to be using their capital wisely, investing in subsidiaries, launching products aimed at higher margins.
But, like we discussed, it's not entirely smooth sailing. There are friction points. Which brings us to our final thought for you to consider. Given the impressive H1 results, that aggressive push into EVs with the Orbiter and the King Cargo HD EV, how significant is that specific constraint they flagged? Magnet availability. Does a tangible short to medium-term supply issue for a key component pose a bigger strategic threat to their EV growth ambitions than, say, the unknown future cost of those new ELV regulations?
It pits a very real, immediate supply chain risk against a potentially large but still undefined regulatory one. Which pressure point do you think will bite harder in their next quarterly results? Something to mull over.